Yeah, my name is Jaspreet Baveja, and I am in the Bay Area. I have been in real estate, like I said before, since 2017, and then quit my job in 2019 to go into real estate full time. I invested passively initially as an LP in about 6 deals. Then I got towards the GP side and took my first GP role in 2021. And since then, joined Fairwinds as a partner, and we have since grown that to be partners in, like I said, almost 700 units and about $85 million worth of assets under management. So real estate overall as a vehicle is amazing to achieve sort of this financial freedom, wealth creation, passive income strategies. And I think if you are a busy professional, or you've got your own business, or you've got a great paying job that you love and would hate to leave, that's when you look at the passive income strategy of investing in syndications. You are a professional in your realm, and then you are able to then trust professionals in the real estate space to manage that investment on your behalf. And that's a very powerful thing to say, hey, I may not be the one managing the day-to-day, and I'm going to maintain what I love doing, and I'm going to go ahead and still have someone else who understands this take over my investment strategy, not be an advisor of any kind, not be a CPA, not be an RIA or a financial advisor of any kind, but truly being able to say, okay, well, I'm investing in this asset or this asset class, or with these investment managers who can go ahead and put it in a fund that's going to put it into these asset classes. And so it just allows for people to have a little bit more of an option beyond their IRAs, 401ks, and mutual funds and stuff like that. So you can go ahead and switch to the next slide.
Yeah, and I just want to, ask you the difference between kind of what's the benefit of, like, why wouldn't I just invest in a REIT,
Yeah, I think REITs have a considerably lower return rate. REITs have a much larger sort of overhead on them, and they have a lot of restrictions around what they can and cannot do with the money that they do get back in dividends. I think up to 90% has to be dispersed. And overall, I think the tax advantages of being in an individualized asset or in a fund that is investing in direct assets allows you to get these negative K1s, which I don't believe the REITs are really able to take advantage of too much. So there's tax differences, there's investment returns differences, there's the asset class differences. And I think if you initially start with syndications, it allows you to learn more about individual assets, individual markets, individual operators, and get to diversify your risk before going into a REIT, which has complete autonomy on, okay, well, we're going to go into this asset here, this class for this long, and this is the kind of leverage we're going to get, and your money's just going to get divided up, without having really any idea as to how these people really manage their stuff, what's their communication like, what do their updates look like, what's their investment strategy when they hit a snag. And so I think syndications allow you to be able to come in with a lower dollar amount up front, get to learn the ropes, get to do a deeper dive, have a more personal relationship with the people that are going to be managing your asset on your behalf. And then as you learn and grow, I think REITs become better for those seasoned investors to say, hey, listen, I get it. I know the process. I understand it. I'm okay with this lower return, but it's lower risk. I know I'm going to get X amount of money back, and at this frequency, that's all I care about. And so they go into those REITs. But I hope that answered it.
Yeah. And I mean, to your point, I think one of the amazing benefits of syndications is you get a piece of the equity, right? Yeah. And as we all know, wealth is built in the equity. Cash flow is completely defensive mechanism just to keep your property and to maintain it. But you make your money in the equity and appreciation, in my opinion. So
exactly. Yeah. Whether it be a refinance, cash out refi, or a sale, the exit's really where you're going to make the most money.
Exactly.
All right. So this presentation is for informational, educational purposes only. My lawyer sort of forces us to put all this in here. So essentially it's just a disclaimer. Don't listen to me. Don't trust me on anything. I know nothing of anything, and I'm just here to talk. So these are my opinions and opinions only. Talk to your legal representatives, tax advisors, brokers, anybody you want to, licensed professionals, before you make any investments. And I'm just here to provide my opinions and what I think is the market's doing. All right, just a little bit about me. My family of 4 right there in the corner. I've been in real estate, like I said, since 2017. In 2018, I did my first private loan. I quickly turned that into almost 40 within a year, and then now over 300. It's been an insane cycle, but considering the fact that I've got a 0% default, foreclosure, loss of interest or loss of payments or loss of principal so far across my loans, something must be going right. And I've got two businesses, like it says, JGB LLC is my private lending space, and then Fairwinds Capital Investments is where I am part of the multi-syndication side. My family and I love to travel more than anything else. We did 9 countries and 3 states in 2019. I think 2020, we just took a break because the whole world did. 2021, we got the itch again. So Miami, Maui, stuff like that happened. And then 2022, we just burst out, and Dubai, Turkey, India, local travel, we're back full swing. And today I'll try to go over the key components and experiences that now allow me to co-own large apartment complexes all over the nation and invest passively while sort of generating income on my own terms. And I say literally because I provide the terms as a private lender around rates, points, fees, payment schedules, stuff like that. All right. So some of my experience. The very first top is the GP and syndications. So like I was saying, almost 700 units under management, 85 million worth of acquisitions. Our latest projects include a 221 unit hotel to multifamily conversion in Houston, where we also have hundreds of other apartment units. LP and syndications, like I was talking about diversification, I am all about it. So you can see from multifamily in California and Texas as a limited partner and Virginia, I forgot to add that, LP in Virginia as well. Self-storage, raw warehouse to self-storage conversion in Ohio, CBD extraction facility in SoCal, office space in Colorado Springs, rented out to Northrop Grumman, warehouses rented out to, I think, 7 or 9 different marijuana operators in Boulder. Then I've got rental properties from short-term to single-family duplexes in Indianapolis, and I've done flips in Austin, Indiana, private lending. Like I said, crap load of private lending overall just in the Indianapolis space, and that's sort of where I am right now. I'm in the home that I'm in. I was living in a 400 square foot studio with the family of 4 that you just saw for 18 months while we sort of rebuilt this home from scratch. And so, yeah, it doesn't matter if you're a millionaire or not. You just do things that make sense. You do stuff that others won't, so that you can then do things that they never can. And so that's the mindset I had, and decided to live in the studio while we got the house done. And now it allows me to live in this beautiful home where my mortgage will be basically 80% covered with just the rent from that studio whenever I get somebody in there. So yeah, I'm very happy with the decision we made, but painful through COVID to have 2 kids and everybody working from home out of a studio. Insane. All right, next slide. So 5 top reasons, or was that the next one? Okay.
Oops, sorry. There you go.
Yeah, so top reasons to invest in multifamily real estate. When I talk about multifamily, that's why I clarified it earlier. We are talking about a commercial multifamily real estate. As Fairwinds, we've generally never gotten into deals that are under 50 units. We have done a couple of them, but generally speaking, now our criteria is at least 100 plus units. And the more units you have, the more these things come into place. Consistent cash flow, right? If you have vacancy rates, when you have a single family, one person leaves, 100% vacancy rate doesn't help you at all. If you got 100 people in your apartment complex, one person leaves, you're barely at 1% vacancy. So it allows for a higher chances of consistent cash flow. It's a secured means of passive income because you're going into a much larger deal. You have equity stake as a limited partner. You got the potential to build wealth, just like Andrew was saying, at the sale or cash out refi, you're going to get most, if not all, your capital back. And then everything after that is gravy, right? So you have a much higher potential to build wealth and time and financial freedom. You don't have to worry about constantly managing the assets. You're not getting phone calls from your property managers or even us as asset managers, because you will be the one to call in when you feel like asking a question and saying, hey guys, the last update I got on a consistent basis had something concerning or didn't really have this in it. Can you tell me why, right? It's you choosing to talk and get information rather than consistently having to address issues or concerns or questions from management to tenants sometimes who have direct access to you. And then tax benefits. This will, of course, depend on your tax brackets, your tax situations overall, your full-time jobs, real estate professional status or not. But overall, there's tax benefits regardless of any of that to say, well, I'm going to take depreciation. I'm going to take that against any appreciation I have. I'm going to go ahead and do cost segregation studies, like you mentioned. We're going to do bonus depreciation as long as we have it, right? 100% this year, then it goes down, but it's still there for a few more years. So whatever we can use, we want to leverage that to reduce our tax burdens and be in a more tax advantageous investment vehicle versus a lot of the conventional investment strategies out there. All right, next one. So this will go into more of a structure of how syndication works. We've said limited partners, LP, a couple of times now, and then the other half of the equation is general partners. Those are the operators and the lead sponsors, and these guys will be us, Fairwinds. We will operate the asset actively. We will execute the business plan or ensure that the business plan we had that we talked to the property managers with actually gets executed on time. The contractors are working. We're getting our rehab budget managed well through our lender, and we'll contribute, of course, our expertise. We will even bring our own money to the table. A lot of times, upfront due diligence, the EMD, the travel costs, legal costs, bank fees, security deposits. I mean, there's just good faith deposits. There's so much money that goes into a deal. And a lot of times we will put all of that up front, and then as we raise limited partner capital, we can then pay ourselves back at the back end of the property purchase. And then we have, of course, equity and fees that we will earn through the deal for all of the countless hours and headaches and travel and expertise that we provided on the deal. And then as limited partners, the investors will come in and contribute capital. Sometimes our limited partners are pretty well seasoned and they will actually contribute expertise or bring networks to the table or relationships. And that's always helpful. But essentially, it is a passive investment. You put the capital in, you sign, you look at the PPM, you look at the subscription documents, you look at the offering memorandum, go over the business plan, and get any of your questions answered, and then you invest the money into the deal. And then you get dividends on a monthly, quarterly basis, depending on the deal, whenever the cash flow permits it. And then, of course, you get a portion of the equity back end whenever there's a cash out refi or a sale to recapitalize your initial investment, plus any returns that we promised.
And to that point, so how do you guys fund your soft costs? Because I mean, as you know, in these large buildings, it could be upwards of $50,000, $100,000, $200,000 before you even buy the property, right? So how do you go about funding them? Do you fund them through your fees, or did you and your partners kind of put some money up front when you started this business, or how do you go about funding those?
Yeah, I think a lot of our own capital went into these deals. We bring KPs to the table. So if we have EMD partners, let's say these are people and relationships we've had for a while who know, like, and trust us and believe in our plans, they will say, hey, listen, I'm willing to put in the $75,000 you needed to put the EMD down at the title company to take this property under contract. I'm willing to put that up for the next 60, 90, 120, whatever number of days it takes for you guys to close. But I want that money back at closing, and then I want X percentage equity in the deal as a general partner for giving you this cash. Or it could be a key principal who's bringing, let's say, their net worth and liquidity to the table to get us approved for a loan. Similar strategy, they can get a percentage of the GP stake because now they're actively involved in the deal. And a lot of times we'll put up our own money up front, depending on the dollar amounts. The last deal we did, we had to walk away from the deal, had $6 million raised in our bank account, and had to wire every last penny back to the investors because we didn't close the deal. But we lost $500,000 of our own money as hard costs in the upfront due diligence, EMD, hard costs, soft costs, legal, bank legal, all that jazz. So, there is a lot of risk up front, but then you get compensated accordingly on the back end upon a successful exit. So as general partners, again, we take that risk on up front, and that's why we sort of charge those fees and take equity in the deal so that we get compensated accordingly for taking on that risk.
I love that you mentioned, how not all deals work out, and sometimes you lose money on deals, but
Oh yeah,
at the end of the day, there's just cost of doing business. I could lose money
100%.
on, my soft costs on a 4-family. When you're dealing with $100, $200 units, that cost is amplified. But it's really nice to hear that you're honest and vulnerable with your clients. So
Yeah, I think I think the key component, so Fairwinds Capital, 3 of the partners are all Navy, US Navy, and I'm a merchant marine guy. So all of us have been on the sea. We all have had that sort of captain beat down into us, and integrity, honesty, all of that stuff is sort of high priority for us. And that's what's important, is to make sure that we are honest upfront, totally open books. Everybody knows what's going on, keep them in the loop, share updates, provide as frequently as update as possible. We have Slack channels with a lot of our investors to say, hey, listen, this is what's going on, this particular deal, this is what changed, this is what happened. And so I think for us, even if it's not a win or as strong of a win as we wanted, we want to make sure that we are as transparent as possible with our LPs, KPs, co-GPs, capital raisers, equity partners. There are just so many relationships you build in this business, and this business is truly, believe it or not, a relationship game. And more than anything, the relationships will last and make you successful. So to do that, we made sure that we wired the money back as soon as we knew that it wasn't happening, and then we ate the upfront costs, right? So that's on us to make sure that we maintain our integrity and do what's right.
Couple questions, if you don't mind. So
Yeah, go for it.
If you get to this later or you want to answer it at the end of your presentation, that's totally okay. The first is, do you have a typical kind of profit breakdown that you do between the GP and the LP, like a 70-30 split or something like that you like to use? And then the second question is for the fees that you charge, what types of fees do you like to charge? Is it just like asset management fees, or do you work in other fees as well?
Yeah, so typically I'll just answer it now since we have the structure up on the screen, that typically we have a pref and then a split to a certain IRR and then a separate split. So it's a waterfall structure. We have done as high as a 12% preferred rate of return for our LPs. And then from 12 to 18, it was 70-30. And then after 18% IRR is achieved, then it was 50-50 thereafter. Of course, 70% going to the LPs, 30% going to the GPs. And as the deals have become a little bit slimmer, we have gone down as little as 7% pref, which was market anyways. So we were way above market on most of our deals. And that's what we were doing to build relationships and make sure that we have investors, and we delivered on our promises. We think we delivered like 54% IRR on average in the last 2 deals. So we definitely beat our expectations, but the market had a lot to do with it at the time too. And overall, so we'll do 7, typically 8% pref, then 75% to the LPs from that 8 to 18%, and then 50-50 thereafter. More than likely, our fees are limited to asset management fees. Other than that, it's just us covering CPA costs. So whatever the hard costs are that are assessed at the property level or at the management level, that's what sort of just gets taken out from the operational income. There is nothing else that we charge for as asset managers.
Do you guys outsource property management, or do you have an in-house property management or your own property management company?
So we had an in-house property management company for our Virginia-based properties. We just, as of yesterday, merged it with another property management company to allow for us to focus more on the asset management side. But overall, we like to rely on experts. Just like I said, if people are relying on us as experts to manage their investment, we want to make sure that we rely on experts for that same thing. And so we look for property managers that have, a good size of units under management in that local market, have experience, have good contractors, have good relationships with local vendors, so that we can be successful in our investment strategy.
Thanks.
Yeah, definitely.
And just for the newbies out there, pref is preferred return, which essentially is just a guaranteed return.
Mm-hmm. We can't use the word guaranteed, Andrew.
Well, not guaranteed, but it's they get the money first. If there is money, exactly, they get the money first.
Whenever there's money available, up to 12% or 8% of that. So let's say they put 100,000 in, and we got cash to give. that one person who got 100,000, the first $8,000 of that profit will go to that person to make them whole, and of course prorated across all the investors, so everybody gets the equal share. And once that preferred rate is met and there's still more to give, at that point we do 75% of that profit goes to the LPs, 25 would come to the GPs, and up to 18%. And if everybody's made 18, or at least the LPs have made 18%, and there's still more to give, at that point we would then split that remaining profit 50-50. So that's the way the waterfall would work.
And when they say a 70-30 split, that just means 30% of the equity goes to the GP, 70% goes to the LPs.
Yep.
And they range from, you know, from 90 to 50 usually.
Exactly.
In syndications.
That is correct. Yeah, I think the more. Oh, go ahead.
Sorry, why don't you finish what you were saying? Because I don't want to interrupt.
I was saying that I think sometimes the more experienced or the more hyped or the more advertised or marketed the investor is, or the syndicator or the sponsor is, and the more they feel like they've got enough presence that they don't really care, the higher you see that split go to them up front, and the lower to the LPs, because they say, well, we built a name for ourselves. We're Grant Cardone. We're going to do whatever we want, and we're going to do 90-10, and you're going to like it.
What do you use to keep track of like these waterfalls and then ultimately paying out the distributions to the LPs? Do you use a special software, or do you do it all in spreadsheets?
So we leverage our CPAs and our bookkeepers to manage that effort. We have property managers, property management companies will provide us with weekly reports, monthly reports, cash flow reports. Our lender will, of course, review those same reports and get paid accordingly, and we do draws. And so at the end, or every quarter, or whatever our schedule is, we will then pass that along to our CPAs to then calculate, okay, do we have enough in reserves to meet the lender requirements? Do we have enough reserves to meet the property management contract requirements? Once everything is met, do we have enough left over? And then based on that, then the CPAs will go through the agreements that we have, the subscription documents, and then assign payments accordingly that will come back to our software. So we use Syndication Pro to manage the distributions, and then it will come back in with those people assigned, and then the money will go out as an ACH from there.
Thank you.
Yeah. All right. Some things to ask when you are considering investing with a multifamily syndication operator, syndicator, lead sponsor. And like I was saying in the very beginning, do you know this person, this team? Do you agree with their investment strategy? Have they done any deals? What are their track record? How good are they with project management? Are they focused? I think a lot of these things get answered only if you get to know the team, and that's almost impossible at the REIT level or at a fund level. So it's better to start off with syndicators that allow you access to them as partners, where you can get on the phone with someone, you have their direct email address, you have a phone number, you have something that you can communicate with them with, and then ask them these questions. Ask for their track record. Tell them, hey, listen, I would love to see what assets you've owned, since when, how did it do, what did the exit look like? What was something bad you experienced? Was there a deal you didn't close? Why not? What did you do in that scenario? Right? Because I've heard a lot of people who say, well, hey, we didn't close this deal, but we're going to hold on to the investor money so we can use that as proof of funds to go into the next deal. And we'll just let the investors know whenever we have the next deal in contract. And then we'll give them the option to jump on. And there's just something, a little twinge of unethical, something that bothers me in that. Because now you're not really being open and honest with that team, with your LPs, and just using their money to go use as proof of funds. Oh, we got millions in our bank account. What are you talking about? We can take this property down. Whereas that money was collected for a different deal, which is clearly not closing, and you know it, and you're just not returning that money. So it's just, there's so many different practices that you want to get an idea of from a team. And that's why I think it's better to work with a smaller team or a newer team, or team that gives you access. I mean, heck, in our data rooms, so a data room is just a Google Drive or a box or Dropbox or any folder that we set up where we share data with our limited partners or key principals or even our banks, our lenders. And what we do is we put in our Excel spreadsheet, editable, playable, go log in, modify whatever assumptions you want. All of our assumptions are highlighted right there. We make sure that our appraisals, our property inspections, our BPOs, our CMAs, our anything that we have access to as an operator to understand this market or this property or this neighborhood, we share all of that data as is with our limited partners and key principals and lenders, so that there's 100% transparency across the board as to what we are assuming, why we're assuming it, why we're projecting certain something to exist, and why we have good faith that it's going to happen, and why this neighborhood, why this asset, why this many units, all that stuff, and why this business plan, right? Like, we need to add another playground here, guys, which just has to happen. Well, why? Well, because 90% of this property is a 2 and 3 to 4 unit building, and everybody has 2 to 4 bedrooms, so they all have families, and we have one tiny little playground and no dog park. So we need it, guys. And there's 60% of the people here have pets, and we have no dog park, right? So just whatever information you can gather as lead sponsors and share with your LPs, and make that communication open and honest and transparent, the easier it becomes to garner trust, to allow people to then go in, adjust to their assumptions, to their underwriting, and if it still meets their stringent, even more stringent than us in certain scenarios, because they're like, oh, well, I think the property is going to be vacant 50% for 50% of the year. Like, well, okay, I don't think that's at all possible, but our deal still makes sense. So, right, it makes it easier for them to jump on. All right, trends to look for before investing in real estate. And this, I think, sort of transcends all asset classes, whether it be office, single family, multifamily, commercial real estate. I think most of these things play a factor regardless, because if the population growth is negative, guess what? I don't care if it's a single family or a 100-unit building, you're going to have fewer tenant base. That's always a problem, because that leads to lower rents, lower occupancy, more likelihood of you failing in your business plan. Major developments, that's always usually a good thing. So if Apple's moving in a year and a half, or Google's putting up an office, or Tesla's putting up a gigabit factory, or anything of that nature, all of those are major developments that are going to boost the number of people in that market, in that MSA, and lead to more tenants and lead to more higher rates. Employment opportunities, same thing, right? The bigger, the more the developments, the more employment opportunities there are, and you want lower crime rates, and you want a crime rate trending downwards in the local market. You don't want to just look at, oh, well, Houston as a whole has a crime rate that's going up, but then you look at the half-mile radius around the property that you're buying, and everything has been declining for the last 6 years steadily. Prices have been going up nonstop, a lot of population growth. Well, then, so you need to really come down to, forget the zip code, you want to come down to the property level and then start building a radius out and see how well that neighborhood's doing overall. So just don't get stuck in the macro, get a little bit into the micro to understand the assets and why your sponsorship team is trying to go after this asset, and what they saw that makes sense. All right, do's and don'ts. So don't treat investing as gambling. I know it's at the bottom of the list, but I think it should be at the very top. I know people get emotional sometimes with their investment, and whether it's in the stock market or crypto or real estate, it's more instant gratification. I need this to do well, like right now, and if not, I'm bailing. Right? It's not gambling. You're not going to get instant answers. You're not going to just roll the roulette and you get, okay, black or red. You need to understand real estate is a long-term game. You want to put money into things that you think are going to do well over the next 1, 3, 5, 7, 10 years, and really try to take advantage of the market trends, because the market will always have a swing, right? It's got a cycle. We mentioned that. I think somebody else on your team mentioned the cycle before too, right? You're just going to see that, whether it's an annual cycle of sales or it's the 10-year cycle of the pricing, everything is cyclical, and you want to make sure you take advantage of that. So don't look for instant stuff. Start with smaller investments, diversify. I think I've harped this enough, and try to understand what you're going into. You don't want to go into stuff that is just causing unnecessary risks, or trying to time the market with a falling knife and letting emotions take the lead. So just pay attention, have a goal as to what you're trying to achieve, find investment strategies that meet that goal, and then find operators or investment opportunities that will help you achieve that goal. I think that's all I got, but
Great.
if you guys have any questions.
Um,
This slide is just talking more about, listen, if you're always following the herd and always afraid, you're never going to really make money. So, recessions, as long as you have a good strategy in mind and then you walk in with an understanding of exactly what the market is doing right now, and you adjust your strategy accordingly, and your business plan takes that into account, you're going to walk out way better in 5-7 years from now than if you would have just blindly continued to keep doing what you were doing 6 months ago and start writing offers at 4 caps or 3 caps on a C-class property because that's what the market was doing 6 months ago. So just adjust your strategy, adjust the business plan, but keep taking action.
Yeah, just to echo your point, I mean, the best investors are the contrarians, the people that go against the herd, that when people stop investing, they invest. When people run to invest, they run the other way.
Yep.
So that's, I mean, if you ever read The Intelligent Investor by Benjamin Graham, he pretty much perpetuates that thought. So, but just going back to your presentation, really appreciate you taking the time. Do you mind just touching on quickly your favorite multifamily deal that you've done? Do you have a favorite deal? Could you talk about?
Oh man. I think one of my favorites was as an LP, we invested in a smaller market in Texas, and this operator has only done off-market deals. This was off of CrowdStreet, actually. So as an accredited investor, I was able to get onto that, and they rebranded the property. This was, I think they got it in 2019. So the market was still super hot, continued to go up, and they were next to an army base. They had a great tenant base around it. They improved the property, rebranded the whole thing, and sold it within 2 years, and still walked away with like 20-something% IRRs with consistent cash flow throughout the whole holding. And I think that's definitely been one of my best. And the reason why I say it's the best is because if you can actually get cash flow from your properties and still get appreciation in the 20+% range, you've just done really well. Right now, at this point, you've done both things. You've covered your butt the whole time that you had the investment by getting regular cash flow. And so as somebody who had quit his job, that's what I wanted, was consistent cash flow. And then, of course, you timed the market, just happened to be so, and got out of the property when it was still enough meat on the bone for the next property sort of owner to take over and implement more of that business plan, but still gives you a great return rate.
And for that particular deal, you were an LP.
Yep.
You saw Crowdsource? Is that what
CrowdStreet. CrowdStreet is an online platform that allows operators that are seasoned, have at least 100 million plus, have done deals forever and ever to come on and present their deals to accredited investors and sometimes non-accredited as well. And then you can then use that platform to manage your investment. It produces the K1s from there, quarterly updates come through there, distributions come through there and stuff. So
cool. Anybody else have any questions for Jaspreet?
I have a couple more questions, if that's okay.
Totally.
Go for it.
All right, so, and I'll try to keep them quick because I don't know if we're short on time or how we're doing on time. But the first is on the kind of the structure of the syndication. Do the LPs and the GPs only roll up into one LLC, and does that LLC, that LLC is also holding the property? Is that the way that?
No, we always have a holding LLC that's separate from the LP GP LLC.
Gotcha. Okay.
Yeah, it's just for lending purposes, a lot easier, cleaner as well.
Okay, that makes sense. And then the other question I had is, would you mind explaining a little bit more about the deal that I think you said there was $500,000 of due diligence costs that you guys had to absorb? Like, I'm just kind of curious the size of the deal and what those costs were, and then why you had to back out from it.
Oh man, just had to pour salt on my wounds. Okay, so you're just like opening the can. You're like, all right, buddy, here you go.
Well, I want to hear about your successes and your failures.
Yeah, I mean, I bring it up. I'm the one who openly brought it up just because I want to make sure that it's it's a fair sort of assessment of how this game works. But it was a 221 unit building in San Antonio. And the deal actually came to me off market. The guy literally, the seller, just another operator, syndication operator like ourselves, picked up the phone, called me on my cell phone while I was in Houston. He's like, "Hey, Jaspreet, what's up, buddy? Listen, I've got a deal I'm looking to sell. It's not been doing terribly well for us. We ran out of money, and we would love for you guys to take over. We've got our property management in there, and we just need to get out. It's our last property in San Antonio. We got everything moved over to Houston and DFW and Florida, and we just need to get out of here." All right, sounds good. We put it under contract, had a low EMD, hard EMD up front, and started doing due diligence. We had due diligence teams, GCs, general contractors, property managers, appraisals. Everything was getting done. All of that cost money. I mean, the bank alone's like, "Oh, well, you need to put up $40,000 up front just to even get us onboarded, just to get us started. You need to put a good faith deposit of 40 grand." Or the GCs, "Well, you need to pay us tens of thousands of dollars to do due diligence across 200 and something units to walk every single one, inside, outside, have our individual, let's say a plumber, electrician, da 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 da." And then you've got environmentals that run, you've got appraisals that go on, you've got title costs, you've got legal costs. So when we're doing our PPMs, which is a private placement memorandum, which is a legal document we need for our SEC compliance, subscription documents, which is what an individual investor would sign, offering memorandums, marketing, travel costs, all of these costs add up to a lot. And then on top of that, we needed an extension because the lender needed more time because the market was shifting. And so the lender asked us to get an extension. The extension cost us a few $100,000. So it's just the overall costs are all associated with paying individual third parties to do their individual reports that are needed to get the loan approved, to get you to be comfortable, to get the property manager to understand the business plan and get on board. So these are all just unavoidable hard costs. And the deal went south just because of certain things that we discovered, our lenders discovered, that were not openly disclosed, and made the deal not work for us anymore. So there may be a legal battle later on. At the moment, we're still trying to work it out and see where it goes, but hopefully we'll try to recoup some of our costs. But at this point, we're not really holding our breath.
Gotcha. Okay. Thank you for sharing.
Okay.
Yeah, definitely. And there are certain legal reasons why I can't get into what we discovered, who said what, who didn't say something. It's just, I just can't say that, especially on a recorded call. I'm not going to say anything.
Yeah, makes
Okay,
sense.
I got a question.
I just want to say,
go for it, man.
Yeah, go for it.
Oh,
Yeah,
go
so
for it.
my question is, since the market is shifting, like, is there, a good time to do flips, or is there, I guess, is it a bad time to do flips?
Oh man, flipping is a hard game to get into during a recession because people are getting tighter with their money. Their interest rates are going up, so they want to pay less upfront for a property. And so I think flipping is not the most ideal game plan at this point because A, the cost of borrowing money is going to be higher. B, your average sales prices are, depending on the market, of course, are going to be probably lower, especially heading into the winter time right now across most of the eastern and southeastern United States. There's going to be snow, rain, sleet, hail, all that crap. Nobody wants to go out and buy houses for higher prices in those markets. Heck, even renters will negotiate. I, as a renter, have negotiated lower rates here in California. So I'm sure, across the US, it's easily doable. So overall, you want to get into things that are going to be cash flowing day one, where your higher rates for acquisition are taken into account. And you want to get into less of the speculative stuff, unless you are able to say, "Oh, well, I can get into a loan for 65% loan to value. I'm going to raise the rest of the money from investors, and we're going to get into this deal with a 2.5% interest rate," which is what we're doing on one of our deals right now. We're raising $27 million in equity with a $28 million HUD loan. I so got used to saying FHA with this call. With a HUD loan, and that's at 2.5% for the next 24 years, fixed. Right. So that kind of a deal is something where you can make a good return because your cost of money is so low. But if you're getting into flipping single family, duplex, triplex, quads, it's just a riskier thing to do at this point, unless you know for sure This market does not get impacted. Everybody's going to spend $1 million on a house every day, guaranteed, no questions asked in this market. And I'm going to buy these houses for 300,000 and put 300 into them and sell them for $1 million all day, all night. Sure. But I think anytime you get into something speculative in the middle of or the onset of a recession with high rates, it's just not something I would advise.
So what if it's in a good neighborhood?
Again, it all depends on your research. If your data says that over the last 3 months, nothing has changed, and I have investors or lenders that are going to give me the money I need at a price that makes sense, and I'm going to have to put less of my own money down, and I have contractors and availability of goods, right? So your raw material cost is going up with inflation. Your contractors are going to charge you more. Your lenders are going to charge you more. And on average, again, my opinion only, all markets, submarkets, tertiary markets, secondary markets, primary MSAs are definitely going to see a plateau or decline in sales prices across the board, regardless of the asset class. But yeah, if you think that it makes sense, I can't stop you. I wish you the best for it, but overall, as a general rule of thumb, I would not recommend a speculative business plan at this point in the market.
Okay, makes sense.
I have yeah, you go ahead.
Syed, you were going to say something?
Yeah, I have one question for you. In this market condition, what kind of real estate strategy you recommend? Let's say you're a newbie and we have this market condition right now. And what strategy you recommend to start with?
Oh man, I think at this point, I would say it's better to start with a low leverage cash flowing asset. I don't care if it's a strip mall or a single family home or investing as a limited partner. I think if you can take a property down with low leverage, meaning you can put 40% down and take this property under control, and the numbers make sense, you've got a good renter in there, whether it's a retail tenant, a commercial real estate property, or a single family home, or you can Airbnb it. I don't know, whatever the business strategy is, but if you can get in with low leverage, because your rates are so high now, and still cash flow well, with being conservative on what rents you can achieve, higher costs due to inflations, I think that's the strategy you want to get into. So whether it be an operator or syndicator that's doing a deal of that nature, or you can find a deal on your own that meets that criteria, I think your cash flow is going to be king at this point.
Let's say if you're a cash buyer. So
yeah,
then
again, it all makes sense on cash flow. Even as a cash buyer, I don't know if you're going to be a cash buyer to go buy a $60 million property in all cash. It sometimes doesn't make sense. So as long as you can cash flow and your rate of return, again, I think if you go back up a couple of strides, I talk about pick up a goal. If your goal is to make X percentage return per month or per year, or you need monthly cash flow, or you need just appreciation plays. So whatever your goal is, you need to find a strategy that meets that goal. For me, private lending met my goal because I wanted a little bit more consistent cash flow, a little bit quicker turnover on my money, and I wanted to be able to leverage the market that was just continually appreciating. So I was able to lend my money knowing that the assets I'm lending on are already appreciating in as-is conditions. Forget after rehabs, of course they're going to be worth a lot more. So I had lower risk in that market. And then as I got tired of the transactions, I said, okay, I want to get into more of the longer term stuff. So I got into multifamily and buying and holding multifamily assets. So I think it all depends on what is your goal at this time, what strategy is going to help you achieve that goal, and then finding assets or investment opportunities or syndications that are then going to follow that business strategy and get you to your goal. I don't think that there's just one strategy that works the best in this market. I would just say speculative, sort of that gambling, right? Timing the market, all those stuff that were in my not to-do list is what I'm harping on to say, don't do those things that are just following the herd, trying to time the market and speculative in nature, do things that are concrete, hard costs. Now you know exactly what you're going to put in. You have a fairly good idea as to what you're going to make on a monthly basis. And if you're good with that, invest in it. I don't care if it's all cash or borrowed money. But the primary reason I got into real estate is because it allows for leverage well beyond any other asset class that I know of.
Well, we want to thank you, Jaspreet, for educating the community on the power of syndications. Just to keep the ball rolling, do you mind just telling people where they can find you if they're interested in syndications, maybe where they can reach you?
Yeah, so fwcinvestments.com is our website for syndications. You can find me on LinkedIn. That's probably the easiest way to get a hold of me. And then I can direct you to a Calendly link to talk to me, depending on what strategy you want to go with. But overall, LinkedIn or fwcinvestments.com, and you can sign up for our newsletter or sign up for our investor portal using Syndication Pro, and we'll keep you updated on any new deals we have, or if you want to discuss your investment strategy with us.
Fantastic.
Thank you for having me, Andrew, and Sabrina, and the whole team.